All right, folks, welcome back. This is episode number 10 of the 2022 ICT Mentorship for the YouTube channel. This lecture is going to be teaching implementing economic calendar events with the open. All right, so the economic calendar, many of you probably don't even consider looking at this, but it's important if you're going to be learning how to speculate, study these markets. Certainly, if you're ever going to consider putting live funds in, you really want to know what this calendar says for the day you're going to be trading. Otherwise, you could be surprised, unfortunately, adversely, with a sudden rush of volatility that you wouldn't otherwise expect. This is Thursday's economic calendar for Thursday, February 17th. And not all of these things are going to be heavy hitters for stock indices, but most of them are. And what I'm showing you here is what I teach all my students. I go to forexfactory.com. I use their economic calendar. It's not the only one you can use. It's whatever you like. I like the color scheme they use. It's just a personal preference. You can pick any economic calendar. They're all going to pretty much say the same thing. Here, the medium impact events are like orange, low impact are yellow, and anything that's red, which is not being shown here, would be like a high impact news driver. So when we look at these stock indices, the reason why I teach you 8:30 in the morning, like that's your beginning time to start looking at it, or crosshairs time. The news embargo lifts at this time at 8:30. Typically, there's a bunch of news events that are being ushered into the marketplace at that time. Now, some of these reports or speeches or data points, they may be used as a smokescreen. They may be used as a catalyst to have price go up or down at the time of their release. Other instances, like I'm going to teach tonight, usually there's going to be a build up or a dropping down in price right before the report comes out. And then the real move starts to ensue. Okay, so it'll make more sense as I get into the actual teachings. So right away, we're looking at the daily chart. And as I mentioned in the previous episode, I outlined this high here and this low, and that was the range we were within. And the 50 level was equilibrium. So again, above equilibrium is what? The premium market. And below 50% is a discount market. So we traded back up into the top end of the range between this low and this high, and between these two levels here. Remember, I gave you this low and this high. That's a imbalance. Okay, it's a fair value gap. This market was down in a discount initially after we had the indecisive candle. Go back and watch the 9th episode. If you haven't watched that one yet and you're watching this one, it's going to feel like even more confusion. But we had an indecisive candle here, and we were in a discount. Even though I believe, and I've been telling my own students that I believe we're going to clean out these lows down here, we went to a discount relative to the dealing range between this high and that low. So below it, we're at discount, and we have an imbalance. So it's likely to do what? Go back up and rebalance this before going back down. Listen to what I said in the episode number 9. I said, even if we trade back up into this range, there's trades you can take even if we believe that it's going to go below those lows. That's me tipping my hand to you. I'm not trying to provide you signals. I'm not going to tell you buy here, sell here, put your stop here, take your. I'm not doing that. So if we look at the reference points of it being in a premium market or a discount market, but then we have this imbalance and we have a bias that, and it's likely to go down and take out these lows. So what do we said here in short? The market's been going lower. Yes, we took out some sell stops below this low with the sell side liquidity being taken out here. Then a natural retracement, which is reasonable. Then we start to decline. Then we come back up one more time. Failure swing doesn't go above that high. And then it breaks down and it creates an imbalance when it takes out this short-term low. Wow. That's kind of like the model I'm teaching you. Yes. Now, what's the framework here? We rallied, broke below a short-term low with the model suggesting that these lows may be taken out. So any rally or up-close candle or candles should be viewed as a potential shorting candidate. Now, ring in the imbalance. We traded up into the imbalance one more day. We swept above it, not by much. Then, the next day, we open, we rallied just a little bit, and then plunge. We took out the previous day's low and the day before its low. So both of these daily lows have been cleaned out. Now this one is the next one. Then, down here. So, when I talk about Power 3, I'm specifically dealing with this time frame, the daily chart. if you consider where the market opens, say this is the opening price, in a daily range, if you're expecting it to go down, or maybe you weren't expecting it to go down, you were just looking at the price in your chart, and you see that the opening was here, it rallied a little bit, and it went down, and then closed near the low. Now, that's a rather simplistic overview, just making it very plain, nothing terribly exciting about that. But when you really start to consider it, it is really exciting, because this is the market right here. If you understand this, and you can study a daily chart, daily bias will become easier for you if you start implementing it with this mindset. So if we're bearish, okay, if we're bearish on the market, we're going to anticipate the daily ranges, or each one of these candles, doing this very thing here. Open, a rally, not much of a rally, but it can make a large wick. It doesn't make a difference. But the general premise is it goes up just to go down, and it closes down near its low when it's bearish. Obviously, this would be reversed, where the open would be down here near the low, and the close would be near the high of the daily candle, if it's bullish. But not every single candle in a series of the entire price swing is going to be all up close candles when you're bullish. Conversely, not every candle is going to be a down close candle when you're bearish. But this function of Power 3 is how I teach the bias, and I also teach how to submit to the daily range. You have to learn how to hold to the close. If you're going to just day trade and you're not really participating in the sustained moves that's made available in these daily ranges, like today, I mean, look at this move here. That's nice. Many of you probably took shorts. Maybe some of you took longs. I got some people putting comments in the previous video saying, you know, I saw a fair value gap at this price at this time for a bullish. It's not bullish. We're not buying. Our bias is not bullish. It's bearish. It's already traded to the top end of that fair value gap, and it's likely to go lower now, taking out this sell side and attacking the sell side over here. Okay. All right, let's drop down to an hourly chart, and that fair value gap, the high and the low levels, that's what's being shown here, right there. And these annotations are obviously from what you saw on the episode 9. So watch what happens. The market trades down, finds some support at the low end of the fair value gap, then rallies back up to the high end of the fair value gap, and then breaks right before midnight on the 17th. And then we consolidate, trade back up into what? What is this? What's this right here? It's a fair value gap. Price goes up, rebalances that there. And it's doing it, what time of day? Not New York. It's overnight. European London session. That's just how you can use that model. The same model. You can use it in an Asian session. You ain't going to get a lot of movement because it's typically not a lot of movement in that time of day. But you can trade it in London close. You can trade it in, obviously, the New York Open, like I'm teaching you, and London Open. London Open, if you know what you're doing with the daily bias, you can catch enormous moves. Enormous moves. But sometimes you're going to have to weigh out a lot of give and take back and forth, kind of like today, where the market rebalanced here and then consolidated and waited for a little bit of a push higher. Then the news came out. Okay, so I'm kind of hopefully clear that up for you now. All right, 15-minute time frame. I'm going to take a look at this imbalance here. We rode up into that, rebalancing all this movement down. Remember that paint roller analogy I gave you? The paint was applied to the wall going down, but if all this movement was given to that one single candle, there's going to be little porous places in prices between the high and the low where the market wasn't efficiently offered for buyers. There wasn't much time and back and forth pricing to give buyers an opportunity to get in there and participate. So an efficient market will see the market go back up and reprice that. So it's down and then right back up, like paint being applied to a roller on a wall. You want to make sure you go back and forth to deposit the paint evenly. So there's an even distribution. So again, the background of this chart, that's the wall. And every one of these candles is a paint roller. And whenever you see these big, long, drawn-out candles, there's a strong tendency, not all the time, but there's a strong tendency for the price to go right back up and overlap over that entire range. Same thing over here. We have the market drop down, creates a fair value gap here. Doesn't it take out some lows over here? Yes. There's displacement. And then you can have an order to get in short here. But then watch what happens. This little pump up. That might be scary. It could have stopped you out if it went higher. That's the risk in this, folks. I'm not going to give you a silver bullet that removes losing trades. I lose trades too. You're going to miss moves. I miss moves. Okay. You're going to read it wrong. I read it wrong sometimes. Okay. I'm not perfect, but I'm giving you tools and processes to help you determine where the most likely scenario is going to be. And then you just work those statistical odds, and hopefully with sound money management, which I'll cover, which will hopefully get you to the winner's circle more often than not. All right, so we have the morning session starting before 8:30. We have a rally up, and then it breaks lower. In this area here, we're going to drop down to a lower time frame. But before I do, I want to give you a little bit more details. Think about what I've taught you so far in this teaching for Power 3. The accumulation, manipulation, and distribution cycle of the daily range. If we are trading near the high end of that fair value gap on the daily chart, that's what that level is, okay? When we just drop down to a lower time frame chart. So with this 15-minute time frame chart, and I apologize, the chart's a little bit shifted. It's still the same chart, I just added the annotations. The idea is we're expecting this Power 3 formation where it's open, rally, create the high of the day, sell off, and close near the low. That's what we're looking for. Why would that bias be expected on this day? Because we worked the upper end of that fair value gap on the daily chart. Then we had multiple shifts in market structure bearishly, when we already have a bearish bias on the daily chart anyway. So it gives you a high probability that this day is going to be a down close day. It may not close on the low. It might just be a big down move, and that's all you need. You just need movement. So this level here, it's dashed. That's the midnight New York opening price. This is what I'm referring to when I'm looking at the opening or Power 3 on a daily chart. That price right there at midnight. Look what's occurring. That right there is equivalent to this little tick on this diagram here. It opens, it trades above the opening, just like that candle does on a daily chart. It opens and goes higher. You want to be selling short here. Why would you want to go short here? Well, it went back up in there and redelivered the down stroke on that paintbrush or roller on the wall. Well, now it's going back up. When it's going up like that, it feels unnatural to go short. Like, you don't want to sell short. It's like, this thing's going up. Why would I want to go in there and go short? That's the benefit of studying old data and then reading price, studying it real time, and without taking any demo trades, without trying to pick the targets, forget all that. You want to practice for months, reading the tape, studying price action, watching it. Even if you have to watch it with TradingView's market replay function, there's nothing inherently wrong with it if that's all you have and you can't watch it live. But it is altogether something different and much more beneficial if you can watch the actual live data. So as I mentioned in my own paid mentorship, I always counsel my students to, if they have the means to do so, invest in like I have Camtasia. Camtasia is what I use to make these videos. It's through TechSmith, and TechSmith, you can Google them. It's pretty inexpensive. It's an easy platform to use. And I have had wonderful results with it. I don't have any complaints. I've done all the upgrades every time they have it. It's just really good. If you have a job, or if you have a business that you're running, or if you go to school, or if you just got to sleep, if the time zones don't line up for you, you can set up a recording and just let it record for 8 hours. It'll do it. And as long as you have space in your computer, it'll do it. And then you can go back and literally play that time, real time, and watch the candles paint. Unlike TradingView's replay function, where it doesn't give you the ebb and flow of the candlesticks forming. It's just basically the opening and then a closing of what the candle did. It's kind of clunky and wooden. It doesn't really give you that organic feel of the candlesticks actually forming real time. Whereas if you recorded your screen doing it, then there it is. Don't worry about your screen burn-in time either. Camtasia will record the screen. If your screen protector comes on and it goes blank, it'll still record the screen. All right, so we're looking at the opening price here, and then we're expecting a sell to form. Well, here's that fair value gap. It rallies up into that. Isn't that a sell above the opening price? Yep. Sure is. From that opening price to that high, that's the highest high. Take that range and subtract it from the opening price. That's about in this vicinity here. Okay, right in there. So what's occurring? Well, we have this sell here. Then we have this sell here at the equities opening. And then we have this imbalance in here. So from this range high to that low, multiply that by 2 as a projection. In other words, whatever that low is to that high, that much lower you'll expect to see a short. And it forms right here. That's exactly what I taught you. I did not cherry pick that, folks. You can go back and look at data as long as you can find data on daily charts, okay? And if you can get a intraday chart, like an hourly chart, you'll see it. It's there. But this is a 15-minute time frame. That's my bellwether chart. That's what I teach all my students. This is the one you go to for day trades and or scalps. You can find everything for intraday trading on a 15-minute time frame. If I was held to a decision of what time frame would you be forced to trade with if you had to pick just one ICT, the 15-minute time frame. because I can do anything with that 15-minute time frame. I can swing trade, I can short-term trade, I can day trade, I can scalp. But you only need to have one discipline, one way of doing it. And you might not like the 15-minute time frame. You might like the 1-minute chart if you're trading indices. But you have to have the storyline of the 15-minute time frame to get the full panoramic view of what price is likely to do. So with this continued teaching here, right below here, what's that? That's sell side liquidity, relative equal lows. So you can test this on your own chart. I omitted it by mistake. I apologize. But the low on this candle here is 14,381 even. Okay, don't take my word for it. Go look at your own chart. It's there. So 14,381. I would have preferred to include a line projecting that out in time, because you'll see in a moment when we drop down to the lower time frame. But the setups are forming here above the opening price, right here near the opening price. See that? And inside of the range from the high to the opening projected down, it's in that vicinity there. So it's giving you another opportunity. So again, what's occurred is we went up into that fair value gap on the daily chart. We're back on the daily chart again. And we're anticipating the opening and rallying up into what? Maybe the high end of that fair value gap, or something forming at the news release at 8:30. But if we look at price was starting to pump up higher ahead of the 8:30 news release. So what's that tipping its hand to you, telling you? They're pricing in a premium market ahead of the news. So they're going to use the news to sink it lower, because the bearish bias is going to come into fruition. They're going to expand price lower, and they've already established their shorts because they accumulated above the opening price. And we can see that in the price action of each little short-term rally up, like we're looking at here. So here's 7 o'clock in the morning. It rallies above these relative equal highs and cleans up the imbalance here. And look at that right there. See that? Remember what I told you? If there's two fair value gaps, try to trade it in here, but anticipate and use the money management to allow for your stop to weather a run up into that. And we got it right there. Now, strip it down to what I taught you for the structure of the trade, or the framework. Swing high, broken to the upside, taking out buy stops. So buy side liquidity is taken. Then we have a swing low. It's broken. Did these candles come down lethargically? Was it like a slow meander decline? No. It was sudden. It was a lot of momentum. It was energetic. You can't miss those down close candles right there. That's obvious. They stand out, right? So that's how you know you have a shift in market structure. In this area here, it doesn't have a fair value gap. That's okay. This is only a 5-minute chart. This is where we start doing a top-down strip of 5-minute, 4-minute, 3-minute, 2-minute, 1-minute. The first fair value gap we come to, if we find one on a 4-minute, you don't need to go down to a 3. You don't need to go down to a 2. You don't need to go down to a 1. If you go down to a 4, you don't see one, you go down to a 3. If you find one there, you don't go any lower. Okay? If you don't find one on the 5, the 4, or the 3, and you go down to the 2-minute, and you find it there, that's it. You don't go down to the 1-minute. If you don't find it on the 2-minute, and you do find it on the 1-minute, then that's how you trade it. But what if you don't have one on the 1-minute chart? You don't have a trade. How's that for logic? So we have the continuation lower off of a retracement in here. Now this candle, the high of it, here, I wish I would have used a lighter color, but this candle's high is right there, okay? It actually goes just above that one right there. Not by much, but it does. But we don't need that. We don't need that. Watch what happens. Here's the 4-minute chart. Uh-oh. Something different on this chart, ain't it? We have buy side liquidity here. The candles are a little bit more beefier when we were looking at the previous slide. Look at this one. Look at the candles. They look wonky, don't they? But on this time frame, they become much more prominent, more beefy, much more stout. Like, look at me. I'm here. Take a look at me. That's what we're looking for. We're looking for clean price action where we can see the nice candlestick formations, where we're seeing the even distribution of the price going higher or lower, in this case going lower, but we're seeing that little break where there's not an even distribution of price. That's the fair value gap. So we have that run above buy side liquidity. After rebalancing over here, it goes above it and it breaks down. So we have an idea, okay, we could potentially see a trade short here. I like this fair value gap, but we also have a little bit of imbalance in here. So I want to trade in here, but my money management has to permit me to weather a run up into this area too. Remember that, that's part of the rules. But in here, we're going a little bit deeper. In my YouTube channel, I teach a breaker pattern, okay? And that is a high, a low, and a higher high. That's what this pattern is here, and we're seeing that return here. So if I see a breaker like this, yes, I think the market could potentially trade up into here, but I'm going to use the breaker's candle and just above that for my stop. So I'm not going to go way up here or way up in here, because my foundation to teaching the ICT breaker is the market's going to mostly stay in the lower half of the breaker candle, which is the down close candle right for the big move, up higher, taking out a short-term high. Trust me, the breaker is taught in the YouTube channel in other lessons. I'm not going to pour myself over top of lessons and regurgitate things, because there's a lot of you that have been training with me for a long time, and you don't want to go through that. And the new people that are here, I understand your enthusiasm and you want to know everything like a sponge. I get it and I love it. But trust me when I tell you, that is taught in the free lessons in this YouTube channel. Okay, just remember it's a bearish breaker, and that pattern is the support structure of why I would not expect it to have a higher stop up here. Okay, so here's the fair value gap range from the low and the high end, but it's specifically this candle's low and this candle's high right there. Extend that out in time. Look what happens at 8:28. The candle's showing 8:28 here because it's a 4-minute chart. But once we're trading inside here, all I need to do is trade above this candle's high. I want to be short. I don't want to mess around. It might not give me an opportunity to get in. It might not go higher up into that fair value gap. I want to use the easiest, lowest threshold entry technique to get in, to make sure I'm a part of the move. Then I'm going to be aiming for those relative equal lows. That's that 14381 level, 14,381. Remember that relative equal lows? I said I wish I would have put a line on it. This is the time frame I added the line. It's the 4-minute chart. If you look at the fair value gap in here, okay, and say you're filled at 14,515. and you're aiming for 14,381. Is that 6.5 points? No. Is it 20? No. Is it 50? Mm-mm. Is it 100? Nope. It's more. Do you see a pattern here? One contract? Folks, what I'm teaching you is literally a ATM machine in your hands. I'm giving you the PIN numbers. Every time I do a video here, I'm giving you another digit. And once you figure out what is it you want to do with this content and make it part of you, and you'll see what I mean by that. Right now, you might see me showing you. It's like, man, this makes perfect sense. Most of the comments that I don't allow to be posted are just sugar, sweet, diabetic coma type lovey-dovey comments. And I'm not making fun of that. And I appreciate it. I know what you mean by it. And you want to show your adoration and respect. And I love that. But don't lose sight that you're feeling that splash over because I'm literally taking you into the chart and showing you what I know. And you're excited because you know the opportunity is available to you if you stick to this. And that's the right perspective. But don't lose sight and think that, oh, I just watched that video and I'm going to go out there and trade. Because I've had some people post in the comment section and they try to do something with live accounts, which I already said, no, don't do that. And they're saying, I don't think these concepts work because I tried to do this and I tried to buy this fair value gap today. And you know who you are, and I'm not trying to make fun of you. I'm not talking down to you. But the bias is bearish. So if the bias is bearish, would you go in looking for a bullish fair value gap? No. That's the purpose of having a model. And then with that model, each morning, before the markets even start trading, you write down what your intentions are. What does that mean? I gave you the range, right? Here's the opening price. It rallies up to that. So inside that range, you're going to look for a setup to go short. You're bearish. And if it goes down below that low, you can still take a short if it's in this range minus this low. Okay. If it leaves that area, you can't chase it. I don't care how good it looks later in the day. You don't do it. You have to have discipline, folks. If you don't have discipline, your broker's not going to help you with that. They want you to click that button. That's how they make money. And they don't care if you blow your account because there's going to be 20 more to replace you because they've watched ICT videos. They've watched everybody else on YouTube that try to tell you that you can do this. And it's so easy. Even a pizza delivery boy can do it. So hopefully this has helped clear up the idea of bias and power 3. And I will be repeating these themes when it's applicable in the newer videos that come out and examples I'm going to teach with. But for now, I can't say it enough. What you were just exposed to, that is the underpinnings of what we do in my camp, okay, ICT. My students, we look at price like that.